Bonjour, très heureux de vous avoir avec vous ce matin, enfin avec nous ce matin. Aujourd'hui, on se fait plaisir, on accueille Peter Hall de EDC. Hello Peter, good morning. Peter, c'est vice-président économiste en chef chez EDC. Pour ceux qui sont avec nous depuis plusieurs années, on a commencé à accueillir Peter il y a bien longtemps et moi personnellement depuis 2009, au mois de mars 2009. Et ce qui est toujours très intéressant, là, c'est pour ça qu'on est nombreux ce matin, c'est d'entendre l'analyse de la situation. Et je vous dirais, à travers le temps, il y a eu des moments charnières. En 2009, on était en pleine crise financière. On a eu d'autres moments où on a vu, par exemple, l'effondrement des prix du pétrole à certains moments. Mais je dirais cette année, c'est particulièrement important d'essayer de bien lire ce qui s'en vient. So Peter, I'm just going to say how glad I am that we are hosting this together this year. I think what happened over the last year was something that was hard to imagine. We're economists. I will say for myself, I never thought that we could close the economy, 40% of the economy in Quebec for 3 months, and then have this robust catch up after that. It speaks to the robustness of the economic system and the ability that we had to take perhaps the right measures, and that's to the politicians. I mean, the politicians did their jobs, but we had the programs, we had the strength of the economy, and then it started again. But there's lots of cloud ahead, so that's why I think it's very important this morning that we have the chance to get your views on the situation and what might be there over the next months. So without going further, I'll just give you the floor, and after that, we'll have an exchange. Thank you again for being with us this morning.
Thank you very much, Michel. You said it perfectly. I can't believe that our relationship started in a very turbulent time for the world economy and the Canadian and Quebec economies as well. 2009 was a bizarre moment for everybody. I'm just going to bring up my slide deck here, and that's going to assist me to tell the story. So what do we actually say about the conditions that we are facing at the moment? Well, the title of my presentation now goes back to a proverb of the wise King Solomon, where he said, "Hope deferred makes the heart sick." So we've been at this now for quite some time. As you said, you know, politicians and government systems from around the world have done an extraordinary job of bridging the gap and putting a bridge over this chasm that we have been traversing, and we're still not there. And so we thought, you know, when it first hit us, okay, maybe by mid-year we're going to be back to normal, and then it was maybe by Labor Day, we're going to be there. Now, you know, the most recent one was, well, maybe when we get to the new year, we're going to be all right. And every time we said, oh, that seems like an eternity, like how can we possibly make it that far? And now we're much further than we thought we could handle, and we are still going on. In fact, we are in lockdown mode at the moment. Well, what is driving all of that deferred hope? I mean, we keep pushing on the hope of actually getting back to normal, restoring our businesses to 100% of pre-COVID levels of activity. What is really going on? Well, my first slide sort of illustrates that. Nous avons beaucoup d'indicateurs avancés partout au monde. Every country has their leading indicators that they look at. And all of those leading indicators are now taking a back seat to this one. COVID is telling us where it is that we are going to go. So there's a negative relationship between the rise in confirmed cases and the economy. They go up, the economy goes into lockdown, either full or partial lockdown. They go down, the economy comes back again. Well, I'm very happy to say that the current measures in place globally see these numbers coming down precipitously. We also see that in the United States. It's even more exaggerated in the United States. You can see that there's an incredible drop here. And of course, the World Health Organization is actually re-examining testing procedures, and they think the numbers are going to go down further because of that. Well, vaccines are also ahead of schedule. So we don't just have Pfizer and Moderna with vaccines at the moment, but we now have Johnson & Johnson coming up with a one-shot vaccine that's storable at temperatures that are very manageable. You can just put it in your refrigerator, and it's actually very effective against the new and most virulent strains of the pandemic. Here are our Canadian numbers here, and we almost seem to be doing better than everybody else. So is this meaning then that we have true hope? Can we actually hope on the economy coming back, and what kind of horizon will we actually see there? Well, one of the things that's interesting is that as we speculate about the timing of recovery, there are some parts of the economy that are fully back already. In fact, there are huge parts of the economy that are fully back already. This is a V-shaped recovery, and this is happening in retail sales. Now, why are retail sales important? Well, for most economies, consumers are 60% of total GDP. In the United States, it's 70% of GDP. So if we have a situation where the US was down 2 months and back in 2 months, fully back to 100% of pre-COVID levels of activity for the consumer sector, then that is a great testament to the strength and the resilience of the US economy. But our question here is it just the US economy, or is it other economies as well? Well, the news gets better, because if you'll ignore the recent data, Europe was exactly the same. 2 months down, 2 months back to 100% of pre-COVID levels of activity. Now you're talking about 45% of global GDP, where the consumer sector is back. So what can we say then for Canada and for Quebec? This is in red, the Quebec number. Well, Canada got hurt worse than the other two and is doing better in the recent data. And Quebec did worse than Canada and is doing better than Canada now. So on average, the consumers inside of Quebec are doing better than not only the US, the Euro area, and the rest of Canada. They're doing better than all of those. You are doing better than all of those areas. Well, this is great news. And you know, what does it actually say to how the recovery is going? Well, those who are cynical in the audience will say, well, it's all because of stimulus. This has nothing to do with a fundamental rebound. And I'll just remind you of a couple of different things. First of all, in the European and US economies, there was significant pent-up demand. And if we had not had pent-up demand, we would not have had this kind of recovery. People would have chosen as much as they possibly could to put their stimulus money in the bank account. Now, there's another thing that is very instructive here as well, because during COVID, many people, most people still had their jobs. They were earning their full wage that they were earning before, and they had far less to spend on. And so what we have actually been seeing is that during COVID, there has been an absolute explosion of savings. This never happens, folks, but we are seeing, you know, an enormous spike in US savings, European savings, and Canada came from almost zero savings, and we saw a savings explosion that was higher than anywhere else. Well, what has this actually done for us? Well, against the trend of increase in demand deposits that would normally occur in the United States, they've put aside an extra $2.5 trillion. Now, this is amounting to somewhere around 13% of US GDP, just sitting inside of demand deposits waiting to be spent. Now, if it wasn't to be spent, they would have put it into investments, but they're just putting it in bank accounts right now, and this is happening right across the US. Half of this is extra money in businesses, half of this is extra consumer money. So this is an enormous store of extra stimulus that is happening inside of the economy. And the retail rebound that we saw happened in spite of the fact that this money was still piling up inside of bank accounts. So nobody's using this to actually create that revival. Consumers are actually fundamentally strong in the economy that we trade with most. Now, the same is true in Western Europe. I don't have a number for it, but let's get on to the number for Canada. Now, what's even more exciting about this is, unlike the United States, where the number has flattened out, in Canada, we're still growing. And so this is a substantial amount of money here, and this is adding up to somewhere between 11 and 12% of overall GDP for us. So that's rivaling a single year of very, very strong public stimulus. And so when the stimulus actually gets withdrawn, we know that we have this in store for us to actually keep the sector going. So the revival that we have seen, as far as I'm concerned, is very sustainable. And if you like, we may actually see even more exuberant spending as we go forward. I mean, the world is running out of containers to ship things in at the moment because of the revival that we see in demand. Okay, so that's it for the consumer sector. Is there any other part of the economy? Well, I could actually go to US housing and show you a few charts of how that market is in huge revival. And if you have any questions about that, Michelle and I can certainly discuss that. But the US housing market is taking off in a way that we have not seen since 2005 and 2006. It has been a long time since we've seen anything like this. And you might say, okay, well, that seems a little crazy, because when people are as confused and as uncertain and as fearful about the economy as they are right now, why are they spending on houses? Why are they spending on automobiles? Why are these large, lumpy purchases actually going up like a rocket? That's a very good question. People would not be doing that if they did not have a fundamental faith in the strength of the economy. There's more to say on that, but time does not permit. If you certainly have any questions about that, I'd be more than happy to answer them. What about the export side? Well, there were many reasons that exports might have really been in deep, deep trouble, but you can see from this chart here that they are not. There's a V-shaped recovery going on in the US, in the Euro area, and in Canada. It's not as aggressive as in retailing, but it is impressive. And you can see that nowhere else is doing better than China right now. They were down 1 month and then rebounded in 1 month. And we're in 2 months back to 100% of pre-COVID levels of activity. And they have been showing very impressive growth off of that new base. So why is it surprising that trade is back? Well, there were many who believed that globalization was over as we went through, last year and in the prior years. Prior to COVID, there was lots of acrimony about globalization being the cause of the weakness in the world economy. There were populist movements popping up in all kinds of countries. There were ad hoc tariffs that were being levied against ourselves, against the Chinese, against the Europeans, and of course there were reprisals that were coming from some of these parts against the US. And so there was a lot of trade turbulence that was going on. Then when COVID hit, of course, you wouldn't want to be the person that was in a truck or a train or a ship that had to go across a border, because everybody was worried about getting infections from other countries and so forth. And so there was a possibility that the fear of COVID would actually stop trade from happening around the world. And in spite of all of those things, trade has roared back. But I have to qualify it at this point in time. One of the key points I make in this presentation, that what is good on average is not necessarily good for everybody. There are a wide array of responses by industry. So here's the number for Canada, and the number for Quebec is not much different from that. I can show that to you if you want to raise that in Q&A. But here's the number for Canada, almost back to 100% of pre-COVID levels of activity. It's the same as in the previous chart, just a different scale. And the reason for the different scale is we've got some real problems. The energy sector dropped precipitously and only came back about halfway. It's still down about 20%. Aerospace, very important to the Quebec economy, and aerospace is actually now doing worse than energy. So on a comparative basis, going back to January of 2020, aerospace is now below what the energy sector is doing. And that's a tragic situation now. Business jets in Quebec have done quite well, because people that don't want to get onto crowded airplanes are actually preferring things like net jets and their own private jets and so forth. So remember, at the end of the global financial crisis, the business jet was a symbol of largesse. and now it's, you know, a symbol of good health. And so that's something that's actually helping to rescue the production inside of Quebec. The auto sector, so there's a parts industry that is quite significant inside of Quebec, as you know, and initially this caused us heart failure. Look at the collapse of the auto sector. But this is the sector that is now the most improved sector, because the auto sector knows how to shut down and they know how to come back. They do retoolings, they do plant closures routinely almost every year to make adjustments and so forth. So they really know how to shut down and they really know how to come back. So they're currently at 100% of pre-COVID levels of activity, thank goodness, but we were very scared. What about some other sectors? Well, there's in secteur agroalimentaire à Québec, c'est très massif. It's very significant. It's doing a lot of exporting in the rest of the world. Increasingly, it's doing exporting to Europe. This is a sector that has been doing very, very well. In fact, COVID boosted the fortunes of the food sector, and the forestry sector is also capitalizing on this as well because of the increase in housing activity, both in Canada and in the United States. And so those are two sectors that are doing very well. Then there's a very significant metals sector inside of Quebec, and I'm happy to say that in terms of fabricated metals, that's what FM means down there. They have been floating around the 100% level and are doing very well, partly as a result of the revival of industrial production in China, partly also because of the auto sector and because of housing as well. Okay, there are other sectors too. The consumer goods sector, exports, they're also doing well. The pharmaceutical industry clearly doing quite well inside of all of this. Okay, why do I show a chart like this? And why is there a corresponding chart for Quebec as well? It's a bit messy, but it's here to illustrate a point. And that is that I've talked to you about a V-shaped recovery. Some worry about a U-shaped recovery or a W, you know, the dreaded W. You know, how can we actually characterize the way the economy is recovering right now? Well, this is illustrating that when you get down to the industry level, it is a K-shaped forecast. And this is one that really illustrates it, because if I can use one other letter of the alphabet, it's the dreaded L. You go down and you don't come back up again. And that's what's happening for service exports. Now, clearly inside of here is the tourism industry. And so all of our ski hills right now are suffering because international travel and the big spenders are not coming to Le Massif or other places like that Tremblant. You know, this is just the way the tourism industry is being affected. And many in the tourism industry are saying, okay, we're going to have another 0 year. It's just not going to come back fast enough to rescue the summer season for us here. So that's the dreaded L. But what this is illustrating for us inside of merchandise exports is that it is actually a K-shaped forecast. You have the upper arm of the K where industries are doing very well. You have the lower arm of the K where industries are doing very poorly. And this chart tells us some of the industries that are there. Up on the top, big tech is doing very well right now because everybody is trying to digitize and mechanize in a hurry. Retail tech is doing well. Retail low tech is getting crucified right now. Unfortunately, if you don't have Interac, if you don't have Visa systems, and, you know, just remember, it was only a few years ago when Tim Hortons required you cash only. And it's bizarre to me to think that a multinational corporation was so low tech just a few years ago. Thankfully, they are not, but others that are really suffering. But retail tech is doing very well. The Amazons and the online providers of the world doing very well. Telecom, agri-food, as I've mentioned before, and of course, the building supplies sector doing a roaring business right now. Go down to the bottom there, and where are we at? Well, we've already said travel, oil and gas, delivery of energy systems, even hydroelectricity, because of the big industrial users being down. That's not been having a very good year. The aerospace sector, obviously, talked about that already, old retail, and the auto sector was down there, not anymore. Well, the K-shaped recovery does not just affect sectors, it affects countries. So if there are countries that are dependent on oil and gas, dependent on tourism, or very trade dependent, they're suffering as well. So as Quebec exporters are looking at the rest of the world and evaluating risks, you need to be very sure about the countries that you're actually dealing in. And of course, that's why EDC is here. It's to protect you. It's to give you risk mitigation strategies when the world gets a riskier place. So keep that in mind with the exports that are going particularly to emerging markets, less familiar, risky markets there. And then, of course, we can say the same about the K-shaped recovery for age and income. Younger people, much more affected by COVID because they're trying to enter the labor force, they're trying to get experience, and it's very, very hard for them to get jobs. Also, the loss of jobs in the service sector, lots of university students not able to secure work for themselves. And then, of course, the income categories. If you are in lower income, typically this is harder than people that are in the higher income categories. Well, this is all very important because as banks, as financial institutions make decisions about extension of credit, they will also be looking at the K-shaped forecast. Will they actually be trying to choose the companies that are on the top? You know, where does EDC play? If there's a capital vacuum, how do we actually fill that up? Lots of questions to be answered by this. Well, we all know the global policy response, huge monetary policy, and there's a list of things there. I'm not going to go into them, and a massive amount of fiscal policy. And you can see that among these chosen nations here, Canada and the United States are on the top of the heap. We are really doing everything that we can to bridge that divide, as Michel said in his opening comments there. So a phenomenal amount of increase here. Now, a question you may want to ask about that is, okay, what do we do about the debts now? You know, we're going to have to think about those. But for the moment, this is what is getting us through this particular situation. So I wrap it up with our forecast here. We have had, because of the new lockdowns, to write down our forecast for 2021. So we were actually over 6% before. We are now at 5.7. That's still a very robust rate of growth. But some of that growth is going to be deferred into next year. You can see that emerging markets are taking the lead. Look at India and how fast India is growing, and China showing a great rate of growth. Doesn't look like the United States is doing very well, actually, lower than most places. Let's not forget that the United States was not as badly affected as others were. And so they don't have as much rebounding to do. Well, because of this deferred growth, we actually get a reasonable amount of growth going into 2022. So again, another year above 5% at the global level. That's very unusual to see the world above 5%, by the way. And you can see that we still have a decent rate of growth. The United States is growing above potential. China settles down, but India still has a lot of catch up to do. Europe still growing much stronger than its overall average for the long term. And so you have those numbers there. What are we doing with respect to currencies? Well, our currency should not be as smooth as it is right now, but because of commodity prices and the way they are behaving, and because of the rise in global sovereign debt, our currency has actually lucked out this time. And so we're very moderate, very smooth movements actually going on right now. And the same is true for other currencies as well. Interest rates, no movements until 2023 in official rates, but be careful because the private sector, the bank rates that they charge will be dependent on where we are inside of the K-shaped recovery. How are commodity prices doing? Well, they're pretty tame as well. We see modest increases in oil and gas going through 2021 and 2022. Now, these numbers are below what we see today. We see today's numbers as being a function of speculation and some short-term supply constraints, but we believe there's plenty of oil around the world, and so those prices will come back down again. And you can see what average we're expecting for both 2021 and 2022. Gold is going to remain high because of uncertainty. Base metals are enjoying a good run right now, fueled by the rise in China's output, but there's also lots of supply there. So we see prices easing back as we get to 2022. How do we wrap this up quickly? Well, here are some thoughts that we have for our discussion period of time. First of all, I think it's clear to all of us that containment of the pandemic is absolutely critical. Keep in mind in your strategy that consumers have lots of cash right now in Europe, in the United States, and in Canada. And that's going to be a very great part of how we recover from COVID in the middle part of this year. K-shaped recovery, I've also talked to you about. You've got to be very, very aware of whether you or your suppliers in your supply chain or those you are selling to are on the top, in the middle, or at the bottom of this K-shaped forecast. Number 4, understand that this pandemic and all the concern is causing businesses to digitize, to mechanize, to robotize, and to become much, much more efficient. At the same time, they're also thinking about reshoring and nearshoring and glocalizing, bringing their supply chain to the market that it's actually serving. So it's not the end of globalization, it's an era of glocalization. And I don't think it's going to happen overnight, but it is something to keep our eyes on, because more investment is going to be seeking to come back into North America. And of course, we are going to have businesses that are going to want to locate in Asia and maybe over in Europe as well, so that they can be producing that much closer to their overall market. So that's number 5. Number 6, mechanization is actually enabling Quebec and Canada to do something that our low and slow growing populations have prevented in the past. We are on the verge of the possibility of being able to get to global scale in many industries because technology is enabling us to do that. And I've already talked about the access to capital situation and how that relates to the K-shaped forecast. Well, I'm very thankful to you for having me here today, and I'm very much looking forward to the discussion that Michel and I are going to have. You know that EDC produces a lot of free resources. Please visit our website, EDC Economics, and you can see many tools that you can use here. I'd be more than happy to discuss those. Thank you for your kind attention. And Michel, I'll pass it over to you now.
Thank you, Peter. Thank you, Peter. As usual, I find it so interesting to listen to all your analysis. Let's get first about this. I will say it's a qualified optimism, or some would say, you know, the analysis is about 2 years with 5% growth rate for global GDP. I would say it's relatively optimistic. Let's just qualify that. How dependent are these numbers regarding what's coming, the vaccination and all that? You know, you discussed about the disappointed hopes. Your numbers and your analysis, is it very dependent on few months of delays or not? How do you see the vulnerability of the next months with the containment of the virus?
Well, that's an excellent question, Michel, and it's probably the most important question that could be asked about our forecast and about anybody's forecast right now. Yes, the forecast is critically dependent on the assumptions that we make about the efficacy and the distribution of the vaccines, and so the best means that we can do to prepare ourselves and our customer base is to consider economic scenarios. So, because we're a financial institution and we have to subscribe to IFRS 9, we are required by law to prepare scenarios of the economy and then to make provisioning calculations based on those. That's no secret to anybody. And of course, we have to pass audit with those. And so the level of seriousness of the use of economic forecasts has gone way up. And this isn't just the case for us. All the banks and other financial institutions are required to do the same thing as well. And so we put our forecasting horsepower to work here because the upside scenario is maybe a bit easier to think about, but the downside scenarios are very frightening, because if we have a situation where the vaccines are not effective, then we would see a situation where we have potentially a collapse of confidence. And if that happens after all we have been through, and we have exhausted so much of our fiscal resource, then we would have a second collapse, and we would remain at that level for quite some time. So we have created that as a scenario. We attach about a 15% probability of that occurring. The upside scenario is actually 20% for us, because the vaccines are ahead of schedule right now, and so far so good. So most of our probability is on our base case and our upside scenario. That's 85% of the probability is there. So that's the degree of confidence that we have in the projections that we have at the moment. But your point is very well made. It all hangs on how we handle the virus.
Maybe another area where I was thinking maybe it's a qualified optimism. It's about the kind of rationality of markets and the fact that we'll remain in some form of a globalized economy. You used the word globalization, and I thought it was interesting. What are your views on the evolution of our American partner there? We have heard different things since the Biden administration came into play, but are we at risk of facing some form of maybe a displacement of investment towards the US because the market would be less accessible? What's your views on that?
Well, that's been a concern throughout the last 4 years. The rhetoric has been very loud for quite some time. I think that while it's the early days of this administration, and there seems to be quite a large push on for Buy American, what the previous administration discovered very quickly was that anything that raises average costs for US consumers is bad for US consumers. And the complaints start to get made right away. And this is a situation, remember, where, even although, we have a conclusive election south of the border, it was very 50-50. Like, there was nothing landslide about this, so that everybody can just say, okay, that's what the people wanted. And, we can get back to the business of building America and so forth. No, there is a lot of friction south of the border. So if something starts to go wrong, by George, that friction is going to bubble to the top, and even the supporters are going to start to get a little twitchy about how things go. So in general, that is what neutralized some of the more incendiary statements that were made about international trade in the previous administration. And I think this administration is going to have to deal with those things as well. That doesn't mean that we have it, that we can relax here. We need to be very vigilant about what the specifics of Buy American are really going to mean for us as we conduct our business.
Let's talk a little bit about the kind of inflation interest rate conundrum. One could say, of course, central banks are not very likely to increase interest rates. But one could say, with all this pent up dollars that could fuel huge demand for goods, that maybe we're going to face lots of demands with the same amount of goods and services available. So perhaps inflation there. Secondly, you have these huge public borrowings, and maybe the people that hold the capital will say, well, for my money, governments, I want you to pay a bit more because I'm less confident that everything will go smoothly. So one thing, you seem to forecast very low level of inflation, and you seem also to forecast very low level of interest rates. What could derail those I would say, confident forecasts?
Well, I think it's a very good question. It's actually two questions there. So I'm going to deal with inflation and the rise of public debt separately, if that's okay with you. With respect to inflation, we're already seeing inflation creeping up in particular areas. I mean, the hot housing market south of the border is the case up here as well. And quite frankly, I see much more reason for it in the US than I do in Canada. They had a situation of pent-up demand. We had a bubble, and we're building on a bubble. What is it that's actually happening to us? Well, COVID has brought a fair amount of discontent with these dwellings that we have been confined to. We see all the imperfections. So we're either trying to renovate them or we're trying to move out into something else. We also, don't like the confinement that we have, 30 stories up in a beautiful condominium because it's become a bit of a gilded cage. It's a bit of a prison up there, and people are pining for a yard that they can go out into and maybe have something to do growing vegetables or flowers or something like that, because there's just not enough to do in your 20-story up condo. And I've heard many people saying, I got to get out of here. Prices of houses that are more rural have risen and so forth. People want cottages or chalet because they need somewhere to get away to. So the purchase of second homes is actually fueling the market. This is going on north and south of the border. So prices are rising there, and that's a bit of a concern because that can stoke the inflation fires. But when an economy is coming back and it has capacity to come back, the critical concern really is how quickly is it going to come back? Like if everybody's feeling really good, boom, all of a sudden things start to go up again. We may have plenty of goods and services inside of the economy. We may have great supply chains, lots of factory capacity and so forth. But if we can't turn it on quickly, then you have this, short-term increases in prices. And that's what's happening with shipping containers right now. The price of those is ballooning. The cost of container shipping has doubled just over a very short period of time because there simply aren't enough containers in the right spot to be able to facilitate all of the trade. There's enough containers, but they're just in the wrong places. And so empties are now becoming a great source of trade. Look, this is always going to happen when you have the economy shutting down and everybody sort of hunkering down and trying to contain costs, and then all of a sudden it comes back. You can't turn it on that quickly. So there is a possibility of a flurry of inflation. So what's the magic that actually gets us away from that? Well, there's lots of stimulus in the economy, and according to the fall statement that our own government came up with last fall on the finances, the public finances, there is an intention of weaning the economy off this stimulus. And when that comes out, it's going to be quite noticeable. So it has to happen in sync with the economy, the regular economy coming back. But the fact that we can actually pull that stimulus off the table should enable us very much to control inflation pressures over the next year or so. Now, you wanted me to talk as well about the debt situation. Did you want to ask that question again, or?
Yeah. Again, it's these huge public borrowings are happening, and eventually, I was mentioning, perhaps the lenders will just say, governments, I want more interest for the risk that I'm taking, because I'm not sure how you're going to get out of that huge debt situation.
Well, there's that. And then there's the 24 academic papers that we reviewed, 17 of which had a rule of thumb in there. When you actually see the debt to GDP ratio rise to the extent it is, how much crowding out of private investment actually occurs, and what does it take off your long-term growth potential? Well, we do a long-term forecast as well as a short-term forecast, and it's a very different exercise, because you're essentially looking at three economic fundamentals. What is your long-term labor force growth? What is the long-term addition to your capital stock? So all the buildings, all the bridges and the roads and the rail and airport networks and all the machinery, the machinery and equipment right across the economy. Add it all up together. How is that changing over time? It doesn't change very much, but the trajectory determines what your long-term growth is. And then how you combine labor and capital together is productivity. And that's the third pillar. That's how you decide a long-term forecast. And from year to year, it should not change. But this ballooning of the debt has actually taken 0.4 percentage points away from Canadian long-term growth by our estimate, and also off the growth of the United States. In fact, the whole OECD is feeling this same thing. So we have just knocked down our ability to grow over the long term. Now, 0.4 doesn't sound like much, but when you compound it over time and you consider you're considering all of GDP, in just a few years, it's worth tens of billions of dollars of activity that otherwise would have occurred. So this is going to be the next greatest issue. Once we're comfortable that we're past COVID, we're getting back on our feet again, mark my words, the ratings agencies are going to come out and they're going to say, you know, we've gone too far and it's time now to go into a period where we try to deal with this and we try to get ourselves back to fiscal propriety. It's going to take a long time to do that, but that's what takes growth off the bottom line.
If I would ask you to venture a risky prediction here, when do you think that those rating agencies will raise the flag? Or do we have a 24-month period before it happens? How long do you think we can live with a situation where it's not the main focus?
Well, I think that we're going to have to keep our eyes both on the ratings agencies and on private banks around the world, because, you know, private banks have said, hey, look, you know, you got to cut us some slack right now. Lending conditions have to be more moderate at the moment, and our regulatory institutions are going to loosen things up so that you don't have to be too concerned about this. But you know that behind the scenes, the banks are still looking at their portfolios and they're doing scenario analysis saying, okay, when we actually come out of this thing, what is it going to look like for us? You know, how are we going to be able to reevaluate our portfolio and then make decisions based on that? So they, together with the ratings agencies, they're both going to be sharpening their pencils at that point in time. I would say within about 6 months or in the 6-month period following the normalization of economic activity, and we're looking at, you know, sort of mid to late this year as being that point. So start there and then consider the next 6-month period. That's when those discussions are going to be had. And, you know, when the first one comes out and makes their assessment, boom, 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 you know, everybody's going to be doing the same thing at that time. So it's both the ratings agencies and our financial institutions. And of course, that's going to be quite a moment for EDC, because if banks decide that they are going to pull away, we're a financial gap filler. And so we are going to have to make some decisions at that point in time as to the role that we actually play.
Let's get back to this K-shaped kind of situation or recovery. We in Canada are at this moment discussing having this debate about those sectoral strategies, and we're pressing the federal government to come up with strategies for the aerospace, airlines, tourism. And probably in many places of the world, it's the same debate. Sometimes they have acted already, sometimes not. We have a lot of companies here, service companies, that are usually trying to go overseas, finding clients, developing their markets. What do you see coming for those sectors that are at the bottom of the K? Some of them, it's not that they have to pivot their model, it's just that they cannot operate. But eventually, they'll be able to operate. If you have a hotel, if you are a Tremblant, or if you are trying as an agency to bring people across the oceans, how do you approach the next months? What's your level of confidence that those sectoral strategies will happen here and all over the world?
Well, that's an excellent question as well. You know, what is the signal that starts everything up? Well, when those infection rates go down to the point where officials say, right, it's now open season again. You can go anywhere in the world that you want as a business person or as a vacationer. And so they'll open the gates, and will there be a rush for the gates? Well, people are going, you know, I don't know. I'm looking at my age. Maybe somebody else should go first. There's going to be that tentative period. And of course, what happens at that point is since they're allowed, since it's open season for the air carriers, they're going to say, okay, well, we're going to need to do some discounting to entice the first people in. We're going to give them really sweet deals, because we know that if we take a group of people over to India for 1/10 the price that they would ever have been able to get before, and this is on their bucket list or what have you, they get to see the Taj Mahal, they get to see all of the sites they wanted to see, and instead of paying $10,000, they pay $1,000. They come back, they're still alive, they're still healthy. You know, people watch them for 2 or 3 weeks and so forth. Oh, they did okay. Okay, maybe I should be, you know, getting in on some of those discounts myself. And boom, you know, people flood back into the marketplace, and they realize that it's safe again. They can do this kind of thing. That's exactly what we saw in the post-SARS period of time. Now, when it comes to businesses, you know, it's open season, so you have the price dynamic there, but it doesn't work so much for business. They don't mind spending on business class and 5-star hotels and all of that stuff. They want to get the business done. So they're going to say, okay, well, who wants to go? And it's going to be a bit of a competition saying, well, I would like to go and seal that new deal in Singapore or in Shanghai or what have you. And so, you know, the first few people do that kind of thing, and everybody goes, hey, they got a big medal on their chest for doing that deal. And they were very gutsy, and they went over there. And so everybody sort of piles into it. For what it's worth, that's why we're all going to be back into office towers as well, because the human behavior dynamics are going to draw us back there.
Interesting. My next question was about the downtowns.
Sorry about that.
No, but interesting, because it's not only because you're answering part of it, which is my analysis of what's happening is that whenever you're going to have CEOs somewhere, they want to have their staff and their colleagues nearby, and then the service they need nearby. And when you're going to get a lawyer finding the deal because he met that CEO in a restaurant, well, the other will believe that they better be in Montreal as opposed to being from Tremblant and trying to develop their businesses. So I agree with you. There's still a sense that we might see a decrease in real estate value in downtowns. Do you share that view? Because it could have an impact on revenues for cities and eventually some dynamism in new construction in downtowns. How do you see the future of downtowns? Do you see it coming back to normal very quickly or something lasting?
I generally do, Michel. I think, in fact, a lot of these industries that are down in the chasm are going to come back. It's a question of when. We organized ourselves in big glass and steel buildings prior to COVID because it was efficient to do so. I don't think it's just because that's what we've always done. This has given us a great opportunity to see how it actually works digitally. So, you know, thankfully, we have the technology to be able to continue on, and that has prevented many, many people from losing their jobs. So we can all be very thankful for this. But is it the way that we would choose to actually operate? Well, you're absolutely right. We went across the country last fall digitally in our executive roundtables, and we had 12 or 13 of these executive roundtable sessions. So all in major centers dealing with the particulars of the economies that we're actually in. And this is just straight across Canada. So we asked our CEO friends who were with us, about 25 per session. So we'd go around the table, we'd do a tour de table. We did the same thing in Montréal. And we asked them, okay, what are your top concerns? And we wrote them all down for each of those locations. Now, number one was, tell us, you know, when we're going to get through COVID. Okay, we understand that. You know, that's issue number one. What's number two? Number two is people movements. We can't send our specialists over to Germany to seal a deal. We can't do a merger and acquisition down in Louisiana. We can't have a new sales arrangement with somebody in Guangdong, because we are not going to do those things and not know the people that we are actually dealing with. We want to have the papers in front of us. We want to see what the terms and conditions are. We want to look into their eyes. And that's the way that business gets done. That was the number two consideration right across Canada. And I was surprised by that, actually. You know, they were also saying, hey, you know, Peter, you're saying we should mechanize, you know, and we're trying to. but we can't get somebody to come in who's a specialist who will help us to actually install this equipment. They've got to come from somewhere else. They've got to come from Italy or France or Germany or Switzerland or something like that. And they won't come. They're not going to go into 2-week quarantine when they get here and then have to go in a 2-week quarantine when they get back home. They don't want to do that. And they can't do that digitally. Like, it's too delicate. This is a $50 million piece of equipment here. I'm not going to fool around with it, right? And so those considerations really indicate to me that the person-to-person is still primordial. When we get to Star Wars, kind of technology where we have, little icons in front of us, those holographs that you have of an actual person, and you can see their facial, the body language and all of that kind of stuff, then maybe we'll get to the point where we can do these things digitally, where the in-person is not an advantage. But it's still that way. And that's why I see, just like happened in SARS, I know that we've got more technology now, but just what happened there, we're going to see people coming together. Why? Because when you're in person, different things happen. And everybody, competitive pressures, behavioral pressures will actually move us in that direction.
I share your views on this. Let's talk about retail a little bit. You mentioned kind of the old retail, the tech retail. In Quebec, we have lots of those companies with franchise and the garment, although all these companies were having global or trying to get global footprint. Now, all over the place, we're seeing the shock of the Amazons of the world and how do you see the future of international businesses in retail? Are we going to have only those international platforms? How do you see it from a business perspective in Quebec that says, I want to be having this global footprint? What are the best strategies to develop that?
Well, Michelle, the interesting thing about this is that when you go into a panic, you've got to deal with the platforms that you have. And so for the moment, it seems like, the Amazons of the world are really, they're gobbling up all of the business. And then if you're in a business and you can't do the same kind of thing, either with door-to-door or curbside delivery or something like that, then it's very tough for you. But we can see that there are Canadian retailers, and even Walmart themselves, they're getting into the game of curbside delivery or door-to-door delivery. Canadian Tire has I think very successfully moved over a model to do it that way, but it does imply a certain amount of scale. When the scale gets lower and lower, it becomes more difficult. Well, what happens in a situation like that? Well, opportunistic people inside of high tech say, hey, what about those little guys out there? What about if we built a platform that could be plug and play with the smaller retailers and so forth? Well, we already in Canada have something like that in a company called Shopify. And so, that's not to advertise for them, but it's an illustration of the fact that technology does not stay silent in a situation like this. Everybody who sees, oh my word, these guys are just about to go down, that means they're willing to pay big bucks for a solution right now. And so, they get working away digitally, trying to craft something together that provides a solution, not only for them, but for many, many others. And if they can successfully do that, well, that'll be their ticket to riches. And of course, at the same time as they're getting very wealthy on their platform, they're rescuing a lot of businesses that are out there. So, it never just sort of draws a line on a particular type of business. It just pushes us to think more creatively about things. In the regular stream of things, we say to ourselves, necessity is the mother of invention. We have a problem, we sit down, we try to figure out a solution for that. It's different now, when you're in a pandemic or when you're in a bad recession or a depression or some other crisis hits. This is a different scenario. It takes that phrase and it ramps it up quite a few notches. Crisis is the mother of transformation. That's what happens in an environment like this. People are not just looking for incremental changes. They're looking for quantum leaps in the way that they actually do their business. That's why one of my concluding comments was that this digitization, automation, mechanization, robotization, the appeal to artificial intelligence is really the answer for so many, if not all, businesses at this point in time. And I think that, you know, it's a move of desperation, but on the positive side, it takes our productivity to another level as well and increases our ability to take on the rest of the world by the increase in our competitiveness, but also by the fact that we can scale it up. As much as we want to invest in, we can scale it up. And so we can actually, as little old Canada, little old Quebec, actually scale up to world scale. There's nothing stopping us from doing that, except maybe trying to arrange the financing for it.
Your time is flying, and I still have two questions that I want to ask. One comes from a participant, and I suspect we have lots of people wondering about that. It's about talent. It's about access to talent and immigration. I've already seen in the K-shaped recovery that some sectors are back to having difficulty finding the talents, and we don't have this influx of immigrants. What's your views on the movement of talent across the world starting perhaps next year? Are we getting back to normal? Are we going to have a huge volume of population that will want to displace themselves, trying to find a better job, better living place? How do you see that unfolding?
Well, Canada and Quebec have always been very successful at being able to draw people into our economies. We're very prosperous. We have a great lifestyle. We protect people's human rights. There are so many benefits to being in Canada. It's a wide open space. You know, the list goes on. And in international rankings of us versus other countries, we always do extremely well. So I don't think we're ever going to run out of the ability to attract immigrants, skilled immigrants into Canada. The last year has been on hold, obviously, because of people movements, and that really has affected our population growth numbers. But we've got another problem because we're not the only ones in the world that want to attract this labor in. There's a fixed amount of it. And so let's be honest with ourselves. You know, our population fundamentals are weak. Western Europe's are even weaker. Japan is weaker than even Western Europe. But with its one-child policy, China is now in a situation where its population is frozen, and they're going to be in population decline for many, many years to come. Russia experiences the same things. There are other emerging markets that are in that predicament as well. There are fewer and fewer places you can go to actually find talent. And so we are going at some point in time to hit some kind of talent wall. It's bad enough already. We had very low unemployment rates prior to COVID. So what does one do about a situation like this? Well, that's where I get back to this whole idea about digital solutions. I mean, sometimes we think it's immoral because we're displacing all kinds of jobs out there. Well, now we have to displace jobs for which there are no people. So, you know, this is a moment really where the mechanization drive is not an anti-labor kind of thing, but it's necessary to keep the economy going. So I would say that, yes, we are going to put a lot of effort, judging by policy statements from our federal government, into attracting as many high-skilled laborers, workers from around the world as we possibly can into Canada. My personal view is we can blow the lights out and it still won't be enough. And so we need to think about digital solutions for our people problem because, like I said, there's lots of global competition for the limited number of people who can actually move back and forth. We're not the only ones. And so we need to have other strategies as well.
Peter, I kept an easy question for the end, which is this kind of, let's say, ecological transition, the impact on oil. We've been having this kind of link between the value of the Canadian dollar and the price of oil. What's your vision of the, let's say, the exchange rate of the future? And are we going to still have a dollar value that is pegged or correlated with the oil price? Is it going to define the kind of our competitiveness in terms of currency for the next years? Or do you see a decoupling eventually just because we will have other strengths than oil. How do you see that evolving?
Well, the energy sector, Michel, still is a very big part of the Canadian economy. That's our reality right now. We're endowed with a resource that's one of the largest reserves of untapped oil in the world. It happens to be very politically safe oil. So if political turmoil happens in Saudi Arabia or Russia or some other part of the world that has big reserves, Venezuela, we could add to that list as well. Well, then Canada is always going to be a place where people who need oil right now can go because we have the capacity, we have the technology and so forth. So I don't think it's something that is going to shut off right away. Certainly with the ecological initiatives globally that we and others are signing on to, there is tremendous momentum behind those things. And so our dilemma is, you know, what do we do with this vast resource at the same time as we are trying to greatly lower our carbon footprint? Well, you know, if I had a solution, I guess, for how that is going to work out, maybe, you know, you and I wouldn't be talking right now. I don't know where I would be, but I don't. And I don't think many people do. It is a dilemma. It is difficult. But given the way that industry in Canada is constructed at the moment, for the next number of years, the oil price is going to be a key determinant of our currency. I would say, though, that increasingly other factors will move in and start to govern those movements. And of course, we'll keep all of our customers apprised as to how we're changing our views on how the Canadian currency is going to move over time.
Well, thank you, Peter. And I will just repeat something you said, which is in this time of uncertainty, I will say that EDC's role is more needed than ever for businesses. Clearly, I think over the next year, 24 months, anybody who's looking at international markets should inquire about the services and the help that EDC can provide. Clearly, for small businesses, it's a must-do. So, thank you again, Peter. Pour tous ceux qui nous écoutent, je vais simplement vous inviter ce vendredi à 10 h. Nous aurons avec nous le ministre Pierre Fitzgibbon, la ministre Mélanie Joly et la mairesse de Montréal, Valérie Plante, pour faire le point sur les prochaines étapes de la relance de Montréal, du mouvement Relançons Montréal. Donc, je vous invite ce vendredi. Mais avant de terminer, je vais inviter Alexandre Faria, qui est vice-président région du Québec EDC, à prendre la parole et à clore l'événement. Thank you again, Peter. It was great again to listen to you.
Merci beaucoup, Michel. Alors, bonjour, chers partenaires et membres de la communauté des affaires. Bon matin, j'espère que tout le monde se porte bien. Premièrement, je tiens d'abord à remercier la Chambre de commerce Montréal métropolitain pour l'événement virtuel de ce matin, qui s'est vraiment très bien déroulé. Très bel échange entre Michel et Peter ce matin. C'était très intéressant. Ça fait plusieurs années que EDC et la Chambre de commerce collaborent ensemble. Puis tel que Michel l'a mentionné ce matin, nous sommes vraiment très reconnaissants du partenariat que nous avons pu bâtir à travers ces années. Alors, merci à Michel Leblanc et toute son équipe pour votre confiance. C'est vraiment très apprécié. Deuxièmement, je voudrais remercier mon collègue Peter Hall pour son excellente présentation de ce matin. J'espère que vous avez trouvé les informations très utiles, surtout dans le contexte que nous vivons. Disons que la crise qui est reliée à la COVID a chamboulé nos vies, mais a vraiment chamboulé notre économie. Alors, on sait tous que le secret de la réussite en affaires, c'est de comprendre l'économie mondiale et ses effets sur l'exportation. Puis, il n'y a pas meilleure personne que toi, Peter, pour nous démêler dans tout cela. Alors, grand merci d'être avec nous aujourd'hui. Alors, finalement, je pense que Peter l'a mentionné, puis même Michel nous a fait un peu de promotion, alors je suis bien content pour ça. Alors, si vous voulez en savoir un peu plus que des CFA, puis comment on peut vous aider à percer, croître et réussir à l'étranger, donnez-nous un coup de fil, ça va nous faire vraiment plaisir de vous aider avec cela. Alors, qu'est-ce qui conclut notre événement d'aujourd'hui? Alors, je vous souhaite une belle journée, puis j'espère vous revoir en personne dans un avenir rapproché. Alors, merci et à la prochaine.